This is the only video that you will need on liquidity in 2024. In this video, I'm not only going to go over what is liquidity, but also how to spot and mark liquidity, as well as how to trade liquidity. Before we get into the video, make sure you guys are following me on Instagram at Arkhamtrades. Let's get back to the video. First, we need to depict what is liquidity exactly. And how we can understand that is by this definition. So this guy is a buyer. For every buyer in the market, there has to be someone on the opposite side, which is a seller. And for everyone shorting the market or selling the market, there has to be a person on the opposite side buying the market. This is how the market operates. So if this guy wants to buy 1,000,000 shares, but there's only 500,000 people willing to sell him, this guy will not get filled on his 1,000,000 shares. And this is where the concept of liquidity comes into play. So for these big banks and these big institutions, for them to get filled on their big orders, they have to trade using limit orders. They cannot trade using market executions because it will not fill them. They have to put it in certain areas in price action where there will be an influx of willing sellers or willing buyers tapping their stop loss for them to get filled. Meaning, for them to get filled on 1,000,000 shares, they have to put it at an area where a large group of traders will get stopped out. This is how they trade, this is how they make their money, and this is how the market operates. This is where the algorithm comes into play. The algorithm cannot see your stop loss. It cannot see your stop loss. It doesn't know where it's at, but it can refer back to old lows and old highs. And where do retail traders put their stop loss? Retail traders put their stop loss below old swing lows and above old swing highs. The algorithm refers back to these areas as, hey, there could be potentially retail stop losses there. Let's draw into that area, take out those retail traders so these big banks and these big institutions can get their fill. So these retail traders who put their stop loss at these levels, they then become liquidity for these big banks and these big institutions to execute on their positions. Have you ever been in this situation? So there's a low, it pushes higher, it comes down, oh, this is a double bottom, or there may be support here. You then take a long based on the reaction from this double bottom or support level, and then you get stopped out only for it to then go in your favor. Or you see this high here, it comes lower, it comes back, retests that high, and then it drops lower. Oh, this is a double top, or there may be resistance up here. You take a short only for it to then stop you out and then go in your favor. This is the concept of liquidity. The algorithm refers back to these old lows and these old highs as potential areas where retail could have their stop losses, takes those retail traders out. These big banks and these big institutions put their limit orders above these levels to then fill them. So as an influx of retail traders are getting stopped out, these big banks are now entering their positions with their buy stops or their sell stops offsetting their buy limits or sell limits, so they can execute on their large orders to then see this continuation. Essentially, they put a sell limit up here. Retail traders has a buy stop right here. Price comes up, takes out those retail stop losses, tags into those smart money or big institutions sell limits. Those retail buy stops offsets those smart money sell limits, they get filled, and then price drops. This is what happens in these scenarios. So how to spot and mark liquidity? So these are some important levels that you should always keep note of. So the first we want to go over is the old weekly high and the old weekly lows. We want to mark these levels out as the algorithm can seek these levels. Then we can mark out the prior day's high and then the prior day's low. You want to make sure you mark these out and understand where is the prior day's high and where is the prior day's low. Then you want to mark out the prior session's high and the prior session's low, meaning if you're in New York, you want to mark out the London and Asia sell side and buy side liquidity pool, which buy side would be here and sell side would be down here. You want to mark out those liquidity pools, equal highs or equal lows, which equal lows would be like this, the double bottoms. You want to mark those out, and the double tops. You want to mark those out if you ever see it. And last but not least, old lows or old highs. Essentially, if you see swing highs or swing lows in price action, you can mark those out, as well as those are areas of liquidity which the algorithm can most likely tap into. Next, we want to get into how to trade liquidity exactly. So this is for your bearish scenarios. We have a high here, price comes lower, price then comes up, takes out this high. The X is remarked as a liquidity sweep. A liquidity sweep is when we take out a high and then we reverse. So that is what the X is for. And the money sign is referred to as a draw on liquidity, meaning if we're seeing lower prices, the market will most likely draw to old lows. If we're seeing higher prices, the market will draw to old highs. So you can use old lows and old highs as areas of targeting as well. So price comes up here, you can go short as price takes out this high, and then these two would be your levels of targeting. This is called the turtle soup. This is not necessarily recommended for beginners. It takes time to really master this, but this is one way that you can trade liquidity, the turtle soup. Or a more practical way for beginners and for new people coming into the market is the 2022 model, which would be this high, price comes up, takes out this high, then we come lower, take out this low. First target met, we see a pullback. This is where you can get into your trade on this pullback here. And then you have your area of targeting right here. Price comes up, takes it out. This is another way you can trade liquidity. Then you have a third way of trading your liquidity, which is your second stage distribution. This would be your first stage. This would be your second stage. So price comes up, takes out this high, liquidity sweep, takes out this high, then it drops lower. First target, structure broken on this pullback. Let's say you didn't get a trade on this pullback. So price comes lower, takes out this low, pullbacks once again, then you can take a trade right here. And then price comes up into target 1 and target 2, which this area would be your final take profit. Then you have the bullish scenario where price comes lower, comes back higher, takes out this low right here. You can take a trade on this low here as the turtle soup, and then seeing your target up here. Then you have the first stage accumulation, where price comes lower, takes out this low, pushes higher, pulls back. On this pullback, you can take a long, stop loss below here, and then seeing your final target met. Or the second stage accumulation, where you see price come lower, higher right here, takes out this low right here, liquidity sweep, takes out this low, pushes higher on this pullback. Let's say you didn't get a trade on this pullback, price comes up, takes out this high, pulls back once again. This is where you would get in for your final target, this old high. And if you're a scalper, you could do something like this, where price comes lower, pulls back right here. You could take a trade on this pullback with your targeting being this old low right here, and you would get a 1-to-1 or a 1-to-2, quick, easy, in and out setup. Or for a more bullish scenario, price comes higher, pulls lower, You have your area of liquidity up here. Price comes lower. Let's say this is your support level or whatever you use to get into a trade. You take the trade. You have a limit order for your first target. Price comes up, takes out that high, and you're out. These are all the ways you can trade liquidity, from the turtle soup to the first stage, accumulation and distribution, to the second stage, distribution, accumulation, to a scalper's approach to trading liquidity using old highs or old lows as areas of targeting. I hope I was able to explain that to you guys as simple as I can, but don't worry, we will have examples for this. But this is what you need to understand about liquidity, from what it is to how to trade it. Now let's get into some backtest examples. First, we're going to look at a GBP JPY on the 15-minute chart. As you can see, we came higher, and since we came higher, we've been making lower prices. So some areas of liquidity that we can mark out is this old high. Next thing we can mark out here is this New York low, which is also the prior day's low. So we have the prior day's low right here as an area of draw on liquidity. So we can mark this out by a money sign, which the market will most likely want to seek that level. So we have these equal highs right here, and then we have the prior day's low, which is also a New York session low. Next thing we can take note of is this trend line liquidity. What do we know about retail traders? They use concepts like double tops, double bottoms, and trend lines to execute their trades and put their stop losses. The algorithm can refer back to these trend lines and these double tops, these double bottoms, old highs, old lows, and refer to them as areas of liquidity. So whenever you see a trend line that's going up like this can also be liquidity as well. So we have double top right here, which is an area of liquidity. We have this prior day's low, which is also another area of liquidity. Plus we have trend line liquidity right here. Retail most likely has stop losses below these levels and below this level as well, and above this level. Plus we have been going lower. So coming into a market, since we've been going lower, retail most likely has stop losses down here and down here. We can anticipate something like take out this high, push lower, pull back to then see our final target met, which our final target can be right here. Our first target could be this trend line liquidity, and our final target can be down here to continue pushing lower prices coming into the London session. Okay, London session's open. We take out these highs right here and do something like this. Stop loss above this high right here. Take profit down here. This would be your turtle soup trade. Then price takes out this liquidity and immediately reverses. Comes down, takes out these liquidity pools down here for the trend line liquidity. And eventually it gets down into our target. Example here we have Euro JPY on the M5 chart during December 1st. So as you can see here, we came higher, and since we came higher, we've been overall pushing lower and lower prices. So overall, the trend of the market is lower prices. Coming into the London session, some areas of liquidity we can mark out is this low. We can mark out this low, and ultimately down here this low from the Asia session. which is also the prior day's low coming into the new day, as well as we can mark out this high right here. So we have our areas of liquidity, plus we have some targets here for a continuation lower. So what we can anticipate is we've been making lower prices. We have a liquidity pool up here. We have liquidity down here. We can suspect something like a push up here into this London session high, break lower, pull back, lower, pull back, all the way down into our final. Come into market here. Price coming higher. We end up taking out this high. Put a sell stop like this. Pretty nice stop loss. All the way down here into our final target. So this could be a turtle soup trade. There you see that rejection. Push lower. This could be an order block right here. Last up close candle. Price comes back up into that order block. This could be your first stage distribution. Put your targeting like this. Price then comes lower. You have this fair value gap. Let's say you weren't able to get into the turtle soup or this order block trade. Could put your limit order right here at this fair value gap open with your take profit down here. Stop loss just above here for about a 1.6R. Price comes up, tags you in. And there you go. From the turtle soup to the first stage distribution to the second stage distribution. All the way down into our final target, which would be this prior day's low, Asia session low. Going over some examples that I have on my Instagram. This is why it's important to follow me on Instagram. Tons of knowledge, tons of back testing studies here. You guys will learn a lot. So first example here would be something like this. This down here would be your turtle soup. Push higher. This would be your first stage accumulation. And buy side liquidity up here. And just like that. This could be your second example. Down here, this would be your turtle soup. You then see the push higher. Fair value gap down here, or bounce price range. Price comes down, taps into it. That's your first stage accumulation. And then our final target up here, this buy side liquidity. And next we could get something like this. Price comes lower, takes out this low, order block right here. First area targeting, final targeting, and boom. And that's going to be it for the video. I hope you guys learned a lot from this video. I hope I was able to give as much as I can, as simple as I could. If you guys want to suggest any other types of videos, make sure you guys leave a comment, like, subscribe. I'm Arkham. Be safe.